Your biggest asset has been down by 5% in the last 3 months. Are you still in cash? Are you still in cash? What are you waiting for with all your money? Do you know the S&P has like absolutely ripped in the last year? I mean, did you get out of the stock market? Now, if you could be in housing, it would be great. Our good friends at Housing Wire said the total equity soared to an estimated $33.8 trillion in May, up from $19.5 trillion in 2019. That's huge.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. All right, Fed fallout and what it means for you, mortgage interest rates, the economy, and the flow of money. Yes, we're still talking about the Fed because they are now driving the bus in a different direction. They've kicked it up a gear, if you will. So the debate of 50 basis points versus 25 is over. Are they going to cut? When will they cut? Now we look ahead, and are they behind the curve again? Now, they typically are. They typically wait as long as possible. Remember when inflation was transitory and they let it get up to over 9%? Well, of course, we know it wasn't transitory. Although, if your horizon is over a couple of years and you think it was just because of supply chain, they weren't wrong. We all just had to suffer in the meantime. Now, inflation is still a worry, and we're going to find out on Friday. Although it's last year's news, and we know it's trending down, and it's great. But the labor market has taken more of the spotlight. But let's not sleep on inflation. The Fed's preferred measure of inflation comes out on Friday. It's called the PCE, Personal Consumption Expenditure. And it's also known as the Fed deflator. Now, it's interesting because in this report, housing doesn't have as big a weighting as, say, the CPI, for example. Like the Consumer Price Index, housing is like 45%. In PCE, I think it's like around 15%, if you will. So part of that is what owner's equivalent rent. What is rent doing? And that's a lagging indicator. And so is home price indices, which, by the way, tomorrow we get July's reading of the Case-Shiller price index, which is big. So we'll see, in the depths of having high rates and before mortgages came down, the last gasp of slowdown in price appreciation will include July. And we already have some other data points from August showing the home prices have started to go up. Obviously, lower interest rates help that to offset seasonally slower times like right now. So the second half of the year, one great barometer of seasonal trends is Altos Research, which is now owned by Housing Wire. Mike Simonson's over there, has a great commentary he puts out at least once a week. Listings are up. They're up significantly. The number of listings are up significantly this year versus last year, and certainly versus pretty much every year since the pandemic started. But 19, 18, and 17, our listings are not as high as those years. So we're back to better than pre-pandemic years as far as listings. And you tend to see some price cuts going into November, and then those trail off. People pull their listings down and enjoy the holidays in the home. And then, of course, the seasonal trends start to pick up in the new year with spring purchase season. So inventory is elevated. It's not historically elevated. And home prices slowed down on their appreciation. We'll get some confirmation of how slow they got with this reading tomorrow, the Case-Shiller Index. But lower rates solves a lot of problems. And I think the Fed just said, you know what, we've done everything we can for housing. If you look at the other parts of the PCE, core PCE specifically, if you look at the other parts of inflation that are measured, they're all under 2%. They're under 2%. Now, that's still growing. It's still growing at, it's not zero or under where we have outright deflation, but they are growing at a pace that is slowing. But wage inflation is now outpacing a lot of those costs. And so have we become Europe, where the Fed is like, hey, we can't build more houses. We can't help supply. Existing homeowners are staying in their homes. The reading for existing homeowners sales just came out today for August, and it was down again year over year, which has been the trend, like 3.86 million homes. Typically, that's at 4 million or higher. We get new home sales data, I believe, on Wednesday, which is made up as much as 30% plus of all home sales. New home sales have been up this year because people aren't leaving their old mortgages. And so, the low rate mortgages at a high clip. They are if that mortgage rate comes down enough. And we're going to talk about where they're going to come down, where the Fed funds rate's going to come down and all that. But, the Fed is kind of giving up on housing, and they're saying, hey, we've done all we can over here. Let's focus on the economy, because these other parts of the inflation data that's going down hurts business. And if businesses can't make a profit, they start to lay off people. And we're seeing that with softening labor. We get jobless claims that come out, which is a forward reading every Thursday. That's a good barometer of the job market. And then the first week of next month, we get jobs week. So we typically get a lot of information the first week of the month. I have to look and see if the calendar is one of those wonky ones, because sometimes it's not the first Friday of the month. If it's like a short week, I think there's only 4 days next week, so I think we'll still get it. Haven't even looked that far ahead. Speaking of calendar, I get this email from StockTwits every day, and then on the weekend they have a good calendar here where they show all the earnings reports and all the economic calendars come out. I look at it all the time. We had S&P Global Composite information. Services were a little stronger, manufacturing a little bit weaker. That's global data from the S&P. Fed Bostic spoke today, Goolsbee spoke, Kashkari spoke. We get Jay Powell speaking later this week. Of course, the home price index, new home sales. But the Q2 GDP reading, the final number, there's like 3 versions, right? There's a revision, next revision, then a final. Should be at 3%. Might be the last time we see 3% GDP for a little while. Because if the economy is slowing and these other non-housing services and non-housing businesses are slowing down their inflation rate, and labor is softening, people are getting laid off, or we're counting a lot of part-time jobs as opposed to full-time jobs. If our GDP starts to slow down, that's what's called the growth scare. So the final reading is expected to be for the second quarter of the year, 3%. Now, we're in the last month of Q3, and there's been some kind of like estimates. Some estimates say 1.8%, 1.9%, 2%. The Fed now, Atlanta Fed, I think they have us at 2.8%. But like a lot of data, when the trend is weakening, these first initial reads come out at a higher number and they get soft. And that leads me to the Fed. Now, the dot plot, the summary of economic projections. Remember, in December, when they said there will be 3 rate cuts this year of 25 basis points each, 75 total basis points of rate cuts for the entire year. They said that last December. Well, boom, they just did 50 on their first move last week. And now the dot plot that came out last week, as of now, is showing 100 basis points of cuts this year, which means the 2 remaining meetings, it would go 25 and 25. The CME Fed tool I just looked at a minute ago has more than half the Fed funds futures bets at another 50 basis point rate cut coming here up in November, 2 days after the election. That would be November 7th. And then on the 18th meeting, more than half have another 50 basis point cut. So the market's sniffing out something different. Now, they're not always right, remember, because they, back in December, remember when they were wrong, when they were sniffing out 6 25 basis point cuts? Well, if we go 50, 50, and 50, they were right all the way back in December, and now they're back to sniffing that out again. So my point is, now that the Fed is starting to cut, and they started with a big 50 basis point cut, they will change. And the pattern in which they will change will be lower. Because if the economy is weakening and if labor is weakening, the trend is your friend. At these next couple meetings, they may do another 50, but they're not going to do another dot plot until December 18th. So will it be another December to remember? Of course, I think that was only September with the good vibes of fall. Anyway, I'll hearken my earth, wind, and fire no more. If you don't believe me, let's listen to our good friend, Elliot Eisenberg, the Bowtie economist. He put this out tonight. Fantastic Fed, okay? In a move largely unexpected, just days ago, the Fed cut the Fed funds rate by 50 basis points. This is an overt acknowledgement that the inflation battle is over and the rising unemployment is now public enemy number one. Logan Motorshami and the Housing Wire team likes to say labor over inflation. I told them they should be selling the swag too. While the Fed should, by the way, I'll be at the IMB Summit next Tuesday in Dallas. That'll be fun. So look out for that. While the Fed should have cut earlier, I agree, I lost a bet over it, that doesn't detract from the gutsy call. Fed policymakers expect rates to bottom at 2.875 in 2026. That's probably too high. Pre-COVID, the rate was 1.5%. So think about that. Are we going to get down to 1.5%? So now I'm checking out the TMS Spotlight from Les Parker, who puts out a great daily newsletter. And they were showing all the dots. I'm looking at the dots here. I can't exactly show them to you here, but if they are going to do 100 this year, 100 next year, and then another 50 in 2026, but if the trend is your friend and economy slows and labor weakens, those numbers could get bigger. And that's how you get to lower rates. And remember, there's a spread between the 10-year Treasury, which has been going up since the Fed meeting, kind of leveled off today though. So we'll see how inflation impacts that and some of the data we get this week. But the jobs week will be the bigger mover of that data to bring that down another leg, potentially, if there is weaker data, more softening, trending, lower data. Even if the PCE goes up just a bit, because the comp that's being removed and the index from 12 months ago was pretty low. So if we come in at 0.2 or 0.22, our good friends at MBS Highway tipped me off to this. We could see a 2.7% that's up, maybe even 2.8%. That's up from 2.6 or 2.5, depending on whether you look at core or non-core PCE this Friday. So are we going to have a lot more cuts than the Fed said on the last dot plot? So I think so, until proven otherwise, right? So the trend is your friend. A lot of other banks, though, they're making their moves. Any minute now, by the way, I was trying to get the live Australian bank. Did they cut? Here's a new update. Give the decision. So they literally are fighting inflation, and they have kept the Reserve Bank of Australia, the RBA, okay, live here right now, right at 9:37 on the West Coast. I'm going to post this video here in a minute. They kept their level at 4.375, so they did not make a cut. Bank of England didn't make a cut, and that weakened the dollar, by the way. In my last video, if you heard me, I said, your biggest asset has been down by 5% in the last 3 months. Are you still in cash? Are you still in cash? What are you waiting for with all your money? Do you know the S&P has like absolutely ripped in the last year? I mean, did you get out of the stock market? Now, if you could be in housing, it would be great. Our good friends at Housing Wire said the total equity soared to an estimated $33.8 trillion in May, up from $19.5 trillion in 2019. That's huge. Equity in homes, that is. And Cal Sweeney over there at 49 Financial sent me a nice little market commentary and update as of September 23rd. The S&P 500 index, just a regular old index fund, in the last year, you'd be up 31%. I hope you're not scared. Like, if you're in cash, are you retired? Are you done? I mean, you gotta get your money working. Anyway, all these central banks are making moves. Fed speakers are talking. Home starts are up. We saw that data that come out, which is huge. Bank of Canada, they've reached its 2% inflation target. So they are the first of the G7, G20 banks to get to their inflation target. So everything's rocking and rolling. Commercial real estate, I got this update from Experian I'm sharing with you that a lot of banks don't have loans and leases. Is the highest percentage of commercial. The average on their books is 2.7% versus 5.9% average pre-pandemic. So with the Fed cutting and rates coming down, that whole commercial real estate bomb explosion was going to blow up our market. It didn't happen. Not yet, at least, and maybe it's not going to. So what is going to happen, right? If you're worried, I'm worried too. Something's going to happen, right? You know what's going to happen? We're just going to keep living our lives. It's going to get a little colder. Cowboys are going to come back second half of the year. My Longhorns are going to dominate. Have a great one. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.